I could just start by giving a little background. I grew up in the New York City area. My parents had the foresight to begin buying townhomes in Manhattan in the 1970s and 1980s, back when that was very out of style. Those townhomes back then cost about $100,000 a townhome, and now cost several million each. And that's sort of the world that I grew up in. My day job was in management consulting. I worked at McKinsey coming out of business school, then Barclays, then UBS. And then at some point, I decided to focus more on the family real estate business. Over the last 10 years, we've started taking in outside money. We now have about 2 million square feet of real estate that we own, about 200 million, actually. As of Friday, we had a closing, thankfully, so we're at about 215 million worth of real estate. And so our focus, our investment thesis is as follows. We like to look at opportunities that are yielding cash day one. Generally, we focus on retail, office, and industrial. We tend to not go in main cities, so we're not in Midtown Manhattan or downtown Chicago. We tend to be in suburban areas that are near cities and in sort of secondary, quieter markets. The reason is we think we have a better chance of getting a good deal if we go to markets that have fewer people like us chasing opportunities. Because we tend to make our money on the buy, and we tend to, we think, buy well, that gives us a lot of resilience and a lot of room for error. So even during the pandemic, for instance, our portfolio has generally performed quite well. We generally have had close to 100% rent collection, while leasing activity certainly slowed down in 2020 when the pandemic was really, at its strongest. In 2022, leasing activity has rebounded, and at this point, we're probably at the greatest level of activity that we've been across our portfolio. In terms of the cities that we focus on, we tend to look at cities where we think that the demographics are favoring future growth. So in the United States, you're seeing a migration away from blue states, blue meaning Democrat, and migration towards red Republican states, which have lower tax rates, lower tax rates and lower costs of living. So that has been our focus in the Midwest and the Southeast. We tend to focus on deals in the 10 million to 30 million size, which tends to be smaller than major institutions target, which goes back to your idea of trying to find good deals at the buy. We try to be very careful in terms of valuation and price. So we'll look at many deals a month, and we'll submit bids on many deals, typically, well below ask. And we're okay getting rejected on most of our bids and only hitting on a few because our whole philosophy is we don't have a fund. So we don't have any ongoing costs that we need to maintain. We don't have to put money to work. We will only buy generally good deals. So if that means we do several deals at a time or we do no deals at a time, that's okay. Because our thought is, as I was saying earlier, we make most of our money on the buy. We want to buy well, and we want to buy in a manner that leaves room for error and surprises. We always work with local on-the-ground talent. So we're based in the New York area. We don't know and we can't get knowledgeable enough for how things work in every state that we're located in. So we will always hire local third-party managers, firms like JLL or Colliers. Traditionally, sometimes we'll go with smaller local third parties. But again, these are people who understand how business is done in these jurisdictions. And then our job is to effectively stay on top of the managers, visit the properties regularly, review financials, and so forth. Occasionally, we will rotate out a manager or a leasing agent if we feel that they're not a good fit for the property. But by and large, we try to be careful when we put someone into place, and then we sort of stay on top of them, so to speak, so that they're motivated to continue to do good work. We tend to buy and hold for several years at a time, if not longer. Our model is every 3 to 5 years we evaluate, should we do a cash out refinance or should we sell the property? Over the 8 fully realized transactions that we have done, we've averaged a 31% historical IRR. That's a technical term which you may not be familiar with, but it's good in summary. Some of the emerging trends we're seeing, which sort of speak to, and inform our continued investing. There's been a general movement away from dense urban cores post-pandemic, and which will favor our suburban focus. Right, work from home is becoming work near home. Many people in the United States have gotten used to not commuting. They want to continue not commuting, but both employees and employers don't foresee a long-term future of people working from their home. Instead, suburban real estate often offers cheaper solutions with larger footprints that are you get to avoid some of the hassle of commuting to the city every day. Many of the main factors that encourage telecommuting don't really impact us because, first and foremost, rent in suburban office tends to be relatively inexpensive. So you don't have the same drivers, let's say, from an employer's perspective to downsize, right? Because the motivation for someone to downsize when they're paying $60 a square foot in Midtown Manhattan is not the same when they're only paying $15 a square foot in the suburbs. And the truth of the matter is, in some ways, just given the experience of the pandemic, some employers are looking to reverse the trend of shrinking footprints. In fact, they now want more space per employee. So that way employees are less likely to give each other, a contagious disease, or even feel more comfortable that won't happen, even if it would not actually happen. I think we can go to the next page. So I'm now going to walk through a few example deals that we have done. I'm not sure if someone was trying to speak. We're going to walk through a few example deals that we have done, just so you get a sense of how we tend to operate. So in approximately 2.5 years ago, we purchased a property in Columbus, Ohio, 355 East Campus View. Occupancy was 80% and investment. Purchase price was $10 million. So this was really at the worst time of the pandemic, and we just thought it was a great opportunity. We bought it at about a 7.8 cap. Our thesis was the occupancy was definitely below the market. It was an attractive cap rate at day one. And the bottom line cost per square foot was quite low. Performance to date was very attractive. We successfully sold the property about a year after we purchased it, and 1 year return to investors was 70%. That's not our typical focus. As I mentioned earlier, we tend to hold investments for several years at a time, but we also try to take advantage of market opportunities where we see them. And this is one in which we just got in at the right time. And then when COVID was starting to fade from economic impact, there were a lot of buyers looking to invest capital they had stored up. One such buyer came to us and just gave us an offer that we could not refuse. Leah, you can go to the next page, please. Here's another example. This is a retail example, which we purchased in May 2019. This was a 40,000 square foot strip center right next to a Walmart in Madison, Mississippi. We bought this directly from a lender that had defaulted on this property. At the time of purchase, it was 87% occupied. Purchase price was $5.3 million, cap at 9.25. The reason why we love this deal is it was right next to the only Walmart in a very wealthy and growing suburb. It was a very attractive cap rate and below market leases. Performance to date has been wonderful. Our occupancy is now at about 95%. We negotiated a long-term renewal with the Dollar Tree store that was in the center. To date, investors have received a 31% cash-on-cash distribution, and we recently did a cash-out refinance, so investors will see a significant portion of their investment returned over the next year. We can go to the next page. Here's another retail deal we bought in 2019, 67,000 square foot. This we bought from a real estate fund that was growing much larger and decided they just wanted to sell some of their smaller investments, well, small to them, and that they were not very sensitive on the price they were selling it for. We were able to buy it for $3.9 million, which is an 8.3 cap at investment. This came with the opportunity for us to build our own building, an outpad. We did sell this after 3 years. Investors received 115% return on their money. And one of the reasons we were able to get the return we did is we developed architectural plans to develop this sort of unused portion at the front of the parking lot. So the next buyer will not only get the cash flows from the existing center, but they will be able to put up a new building in the front of it. So there was just an example of some value that we identified that hadn't really been pursued to date before our acquisition. I think I can stop here. Yitzchak, do you think people, we have a few more deals that I could walk through, but, you may start to see some of the same patterns, which is generally we try to buy well. There's usually a reason why we think something is a good deal. Let me pause here, Yitzchak. I'm not sure if you want to open it up to any questions that people may have. If not, I'm sort of happy to pause here, and people can follow up with questions, of course, at any time after the discussion as well.
Okay. First of all, thank you very much. It was a very clear presentation in terms of your approach and strategy. So first of all, we can open it up to questions that people have in relation to real estate investments. One of the questions in terms of real estate that people, of course, since the whole topic tonight, Larry, is to do with the inflation today of people's concern. So how are these kind of your real estate deals, how do they fare in terms of inflation?
It's a good question. Generally, and I'm not a macro economist, but I know enough to be dangerous. Generally, inflationary environments tend to favor hard assets, right? So buildings, raw goods, and so forth, which just over time tend to be worth more, just by virtue of the fact that prices are going up. Real estate tends to do well in inflationary environments for two reasons. First, rents themselves, right, benefit from inflation because your tenants ultimately have more disposable money that they can spend, right? So if, just to use round numbers, right, if a hair salon makes $100,000 a year in profit and they can afford to pay you $20,000 of that in 2020, and fast forward 10 years from now, let's imagine just because of inflation, they're making $200,000 a year. So nothing about their business has changed other than the value of the dollar has changed. Well, that means that automatically they have another $100,000 of which they can pay you rent. So inflation tends to favor real estate generally from a rental perspective. The other benefit, of course, is the physical bricks, right? You actually own a hard asset. Over time, the cost to put up competing buildings goes up as inflation goes up, right? So if I'm buying something for $100 a square foot, and let's imagine I'm buying it for 100 a square foot, and right now someone can put up a competing product for $150 a square foot brand new, right? Well, in 10 years from now, if it costs someone $200 a square foot to put something up, then my $100 per square foot initial purchase, right, is that much more valuable, right?